So IRR is your annualized return metric. It's really useful to compare the returns across different holding periods. Takes into account all the cash flows. You really want to optimize for IRR. And, well, eventually that's what matters. Hi, my name is Andrew, the founder of 8 Figures, with over a decade of investing experience at Goldman Sachs. And today we're going to talk about IRR, internal rate of return, why it's important, and why most of the professional investors calculate it for each position. So IRR is your annualized return metric. It's equivalent to your interest rate on deposit or APY on deposit. But you can calculate it for any investment, even with periodic cash flows. Let's consider the following example. You've got 3 stocks. First stock is up 10% in 3 months. The second stock is up 30% in 12 months. And the third stock is up 55% in 2 years. So which one of these stocks has delivered you the highest return, you might be asking? Well, the first stock, 10%, may be the smallest in terms of the absolute amount of return, but the IRR actually is the highest. For this stock, the IRR would be 46% because of the compounding. You not simply multiply 10 by 4, but rather there is some compounding that is responsible for extra 6%. The second stock, since it was up 30% in a year, the IRR would be equal, the same 30%. And the third stock that is up by 55% in 2 years would have IRR of only 25%. Again, because of the compounding, it's slightly less than 55 divided by 2. So as you can see, in absolute terms, the picture is completely different as compared to the relative IRR annualized terms. So IRR is really useful to compare the returns across different holding periods. So now you can compare the performance of the stock that you hold only for 3 months versus the one that you hold for 1 year versus the one that you hold for 2 years. Having said that, in absolute terms, sometimes you would opt for the stock that made you more return in absolute terms, even though IRR might be smaller. So the preference really depends whether you can consistently make high return on small holding period. If you can make 10% every 3 months, every quarter, well, happy days, that's a high IRR. But of course, that would require a bit of more active portfolio management or even trading to achieve that sort of return. Another important consideration when we talk about IRR is that it takes into account all the cash flows, such as dividends for stocks, coupons for bonds, or maybe even rental payments if you rent out your real estate as a landlord. And not only the amounts that you receive are included into IRR calculation, but also the timing of those cash flows is important. The sooner you receive the cash flow closer to your initial investment date, the higher its impact on IRR. So the IRR is very useful when you compare investments with different cash flow profile. One investment might not pay you any periodic interest or dividends or other cash flow. Another one may pay you a lot of interest and dividends and cash flow. And one investment, let's say stock, might be up a lot, and in absolute terms, you made whatever, 30-40% on that stock. Another stock might only be up 20%, but because of those interim cash flows and because of the timing of those cash flows, since you receive them sooner, might actually affect your IRR. So your IRR on the second stock might actually be higher than on the first one. And of course, if you look at the portfolio on the long-term horizon, you really want to optimize for IRR. And, well, eventually that's what matters, right? You want to make sure that your portfolio constantly growing at a high rate of return, and IRR does exactly that. The problem is that IRR not always easy to calculate, and IRR sometimes is misleading in terms of its main underlying assumption, i.e. that always assumes that all the cash flows are reinvested into the same stock. and hence the compounding as well. So it might not always be achievable to reinvest your cash flow all the time. Finally, IRR is extremely useful when you need to compare returns across asset classes. Let's say you have a stock that generated you 7 or 8% IRR. And then you can compare this to, let's say, US Treasuries that generating you 5%. And you can see whether this 2-3 extra return that you generate on your stock worth it versus the volatility that you're getting. Or maybe you are better off just investing in government debt that is supposed to be risk-free. Or maybe you have a real estate investment. And once you calculate IRR, including all your rental payments, then you can make a decision whether it's worth holding that real estate as an investment. Or maybe you can actually lever that up, free up some cash flows, and by doing this, decrease your exposure to that real estate and reallocate that cash to government debt, maybe to stocks, maybe to something else. So you can make those decisions, have better analytics, have better numbers in mind with IRR. Professional investors calculate IRR when they underwrite the investment, i.e. when they make the decision whether to invest or not. Then they calculate IRR as they hold the investment, so they can make decisions whether to add to the investment or maybe to sell it. And then they calculate the return when they exit the investment and compare that return with the initial underwriting. So just to summarize why you might want to calculate IRR for each investment in your portfolio. 1, you can compare investments with different holding periods. 2, you can compare investments with different cash flow profiles. And 3, you can compare investment returns for different asset classes. All of that you can't really do efficiently without knowing IRR. And by the way, in 8 Figures app, we calculate IRR for each position automatically. So you know all IRRs in your portfolio and you can make better, smarter investment decisions. Thanks a lot for watching. Subscribe to our channel. Here we discuss investing insights that will help you to become a smarter investor.